Well, on our weekly blog, we've got Chad Hawker from Synergy One Lending. Chad, thank you very much for joining me on this blog. I am so excited that you're giving us a presentation because we just heard the California Association of Realtors economic update at the Monterey County Association of Realtors. And right now, that's the whole buzz of what's going on in the lending world, what's going on with inflation, interest rates, and housing. So I'm looking forward to seeing your perspective on it. Thank you very much for being here.
Always a pleasure to be here with you, William. And I appreciate what you're doing to educate and motivate people out there, whether you're a buyer or seller. There's just so much confusion, primarily driven by the media, as to really what we're dealing with. So thank you to you.
Good. Well, you have a wonderful presentation for us, but I think one of the things that we're going to be talking about is the nouns and numbers of what's really going on in this marketplace, because I liked from the presentation we got a comment that was made by the speaker. He said the brother-in-law effect. my brother-in-law said we're going to have gloom and doom. My brother-in-law said that he heard that the market is going to tank. My brother-in-law said, and you know what? The numbers don't show that. The numbers show we still have a real shortage in housing right now. We have difficulty in getting sellers motivated to sell, and we don't have enough inventory for the buyers that are out there. So it's keeping prices up, and it's really slowing down the market as far as unit sales as well, because this is an interesting time for it. But anyway, I'm going to let you get on with that, and I do appreciate you being here. So I'll let you take over.
Well, I appreciate being here. And as I pull up and share my screen with you, I think that is the message. There is a lot of confusion out there. And although we don't have a crystal ball of what's going to happen exactly, what we do know are the fundamentals and what data is showing us. And the first thing that our brother-in-law wants to tell us is that real estate is falling, and it's better to wait, because if values were to drop, hey, absolutely, let's wait, grab real estate at lower values. But is there any truth in that? And if you look at the data, there simply is no truth. And I'm going to skip around with some graphs to illustrate that, and skip around through this presentation, and also mention that I have prepared some very short, easy to understand videos that you can feel free to distribute on your page. But let's just first look at, as is the case with any product, supply and demand. If demand exceeds supply, chances of the value and the cost of whatever that product is going down is incredibly unlikely. When demand exceeds supply, values are supported and in fact typically go up. When we're seeing that, even with lower demand, because the higher rates have slowed demand to some extent, with inventory so low, it is creating this imbalance, which is supporting value. So look at a couple of graphs. Let's first look at this. Look at the appreciation over the last 10 years, 115% appreciation since 2012. Yes, we saw a little blip last year of 2.5%, but if you read the polls of the National Association of Realtors or Zillow or Redfin, they anticipate a 5% increase in values this year, which very much is supported by a low inventory. So if we look at the inventory levels, this is a chart going back from 2000. We reached a peak of inventory of 4 million in 2007. And at last count, we're hovering right around 900,000 to 1 million in active listings across the country. But what is even more shocking is that of those 900 to 1 million listings, usually 400,000 to 500,000 of those are already in contract, which leaves us with about 500,000 listings across the country. Compared to a typical market, back to this slide, you could kind of take a typical and say, hey, in a healthy market, we're around 2 to 3 million listings, which shows how low the inventory is. So inventory. So obviously very little supply, demand is exceeding that supply. And as we go into the summer months, the buying season, demand is picking up, buffered a little bit by higher rates, which we'll talk about in a second. But this is not a recipe for a crash in values. This is a recipe for stabilization of values or increasing values. We also see the media reports like this one, where foreclosure filings are up more than 150%. This is where the brother-in-law catches wind of this and starts to believe that, hey, foreclosure filings are up more than 150%, values are going to drop. Here's the reality, though, and I know I've shared this graph before. In 2021, there was a moratorium on foreclosures. So they were very, very low, artificially low. And then in 2022, of course, when that moratorium was lifted, foreclosures went up, but still to all-time lows compared back to just 10 years ago, where you can see how high foreclosure rates were. You couple that, which again, the economist today shared with us, is equity. The average equity of homeowners across the country is now around 40%. 40%. Doesn't mean that you're just going to walk away from your house. If you had to walk away from your house, you would sell that home and you would not foreclose on it. It wouldn't be a distress sale. So pretty much anything you look at with low inventory, demand picking up, average homeowner has more equity in their property than they ever have before. Foreclosure filings are, yes, up, but still at an all-time low. Nothing supports values going down. It supports values going up. Now, we're seeing this, and I think these graphs are really powerful to illustrate that just in the last few months, when I first spoke to you at the beginning of the year, William, I said, if you're a buyer, and when the market was a little bit slower, that there was a time to buy, because as we move into the buying season and when rates fall, which again, we'll talk about in a minute, the demand is going to go up, but we don't see inventory picking up dramatically. So this is going to create more of a seller's market and make it increasingly tough for buyers to win and negotiate. And let's see what's happened just in the last few months. This graph illustrates that through January to March, the number of properties sold in less than a month took off. Look at that. Percentage of properties selling in less than a month is now at around 70%. Next, percentage of properties sold above list price, meaning values going up. Look at the trajectory from January to current. This is a clear shift in the market, showing that even with demand somewhat subdued, with such low inventory, this is what's happening. Demand, there's still a big demand amidst the low supply. And lastly, the median days on the market dropping like a rock. Now, median days on the market is now around 22 days. So this once again supports that values are supported. They are most likely not going down. In fact, they will probably going up. And if you were waiting for the bottom of the market, you already missed it, right? It's already shifting. So now is the time, before it gets worse, to get off the sidelines. Rates, yes, are high. They're now hovering around 7%, and there's reasons for why they haven't come down quicker, because many anticipated them to be lower at this point. But strangely enough, a higher rate can kind of be your friend, because as rates fall down, competition will pick up. It will be harder. And as these rates fall and anticipate falling significantly towards the end of the year, first part of next year, you'll be able to refinance that rate anyway. So you're only going to be paying a premium on that rate for a short time. So that's it on the timing of buying and what's going to happen with this low inventory and the predictions on real estate values and so forth. So any thoughts on that at this point, William?
Well, I'm going to just say in general, the graphs clearly define why we have a very low inventory and a tight market. and that really dispels the brother-in-law. Now I actually have a very informed brother-in-law. He's not the brother-in-law we're talking about, but the brother-in-law conversation that happens, and happens just because people hear a snippet. But one of the things that was really clear when you said foreclosure rates are up significantly, well, what I'm seeing is that they're up, but that's because they were at a record low, and they're still 1/10 of what they were or less at the worst of the housing-led recession that we had in 2008 through 2013. That
Exactly.
was a housing crash. And
Correct.
housing actually is a strong point in our economy right now with so much equity. You said 40% equity. That's amazing to me.
Yeah.
So,
Yep.
and if somebody owed using a median price home in Monterey County of 880,000, if somebody owed 500,000 on that $880,000 house, they don't have to walk away from it. They simply put it on the market. If they want to sell it quick, they sell it for $799.
Exactly.
So there, and no more distress. But I don't know how often I've heard saying, "Well, I'm waiting for the market to come down." And I'll tell you, I brought you a client a year ago, that a young lady that was interested in waiting till the market came down, wanted to wait till interest rates came down. You explained to her what was going on. She bought her townhouse. She's already made at least $100,000 on that townhouse on the purchase that she made a year ago, and she has that low interest rate that you advised her in. So thank you for that guidance, and I do appreciate the fact that we need to make sure that we get the positive word out. And you know, one thing that you just said, if somebody can qualify for that 6.5, 7% loan today, that's a way for them to buy when maybe other buyers that don't qualify can't compete with them. However, there is a lot of competition for the smaller amount of inventory we have. But one of the questions I did have is that 7%, is that a 30-year fixed, or is there a program or two that you have that we could get the lower rate, say for a 5-year option arm, or for a 2-1 buy down, that kind of thing?
So let's talk quickly about rates. So we've had some unusual circumstances over the last 3 weeks that have caused rates to go from the low 6s back up into the high 7s, primarily driven at this very moment, the debt deal taking place in Washington. That created a lot of concern, and that temporarily drove up rates quite a bit last week, 0.5% in 1 week. We've already seen that rebound as the debt deal seems to be very, very likely as of today or tomorrow, and rates have already rebounded about 0.3%. The other factor is caused by the banks. You know, there is a lot of tightening within banks. There's a lot of need for banks to create liquidity within their system. And in order to do that, one of the only things they can do is sell treasuries. They don't want to sell treasuries. It actually causes them to lose money, but it's one of the few things that they can sell. And as they sell treasuries to provide that liquidity to their depositors, then that also elevates rates, which is tied again to the banking crisis, Silicon Valley Bank, things like that. So these are situations that aren't based on the fundamentals of what drive rates. The fundamentals of what drives rates is inflation. Just without question, inflation. So we all know inflation is coming down, and this is, I think, just one of the most powerful graphs to illustrate how fast inflation has come down. We pay attention mostly to the blue line, which is the CPI number, and that has been right around 5%. And there's reasons why it's not down more, but it's clearly coming down from its high of around 8%, right? Check out the producer price index. This is the inflationary number for manufacturing. This was at its high of around 12%. It is now at around 2.5% in 1 year. That
Which
is a
is near the
massive
target of what the Fed wants.
Exactly. So inflation for a CPI number is coming down. And as we look at inflation in a CPI number on a 12-month average, we anticipate, economists anticipate that the May number, which will come out in June, and the June number coming out in July, will have very low numbers for various reasons, and I won't get into the microeconomics of it, but they're also going to be replacing bigger numbers from a year ago. This could see the CPI number come down about a full 1% in 2 months. If that happens, many economists believe the Fed, who has been writing very hard on their Fed funds rate to fight inflation, will have to at that point acknowledge that, yes, they know it's coming down, but now it's really starting to respond, and they can relax what they are doing, which has been very tough on the Fed funds rate, which has created a chain effect with the banks, which is just, it's creating a chain effect in various things. So that could, and many believe, start to force interest rates, mortgage rates down, not only back into the low sixes, but into the fives. And then by the end of the year, hopefully around 5, early next year, 5. So you can just start to think about, we've had several cycles this year where rates moved down around 6%. We all in real estate felt it. Things picked up, demand picked up, phones started ringing with buyers. Then rates, for one reason or another, rose because of these extenuating circumstances. Everything seemed to stall out. Then it's done it 3 times this year already. So you can imagine that when rates not only go back down to 6, but enter the 5s, what is going to happen? So it's going to create a huge demand effect with very little supply. So as a buyer, the quicker you can act and then refi when that happens, the better. Now, these are 30-year fixed rates. You asked about ARM products. What's interesting about ARMs right now is there's what's called an inverted yield curve, to where the shorter term treasuries versus the longer term treasuries have higher rates than the longer. So we're not seeing a lot of aggressive ARM products out there, but we are seeing some creative solutions such as a 2-1 buy down. And this is a simple strategy where, when possible, negotiating with the seller, because the seller will provide an upfront credit that will allow you at a stair-step process of having a rate 2% below. So let's say your 30-year fixed rate is 6.5%. They subsidize that payment, so you only have to pay 4.5% year 1, 5.5% year 2, and then 6.5% from year 3 forward. But if the experts are correct and rates fall, you'll be able to refinance earlier, use the money that the seller had provided as a credit at time of buying, and then help pay for that refi. So a little complicated, a little quick way to explain that, but it's a powerful tool to bridge the gap of higher rates currently and lower rates to come. So anybody that's on the fence, that's just thinking they need to wait for rates to fall, or they need to wait for property values to fall, they're doing themselves a huge disservice. There's too many options out there that can allow you to not only take advantage of these higher rates currently, but get into the market before values go up further.
Well, one thing that our speaker today, our chief economist for the California Association of Realtors, said, and it reminded me of an old saying, and he actually said it this way, is that the best time to buy real estate is 20 years ago. The second best time is now. And I think what you just gave is an example of exactly why that's the case. It seems like as the market is getting ready for lower interest rates, we have smaller inventory. So it seems like it's a difficult time because there's so little to choose from. But when you find the right property in this environment, when the time comes to refinance it, it's going to be really competitive with other buyers coming to the marketplace when they perceive it and with the information they have, not the information that you're giving us right now.
Exactly.
And there'll be a lot more competition, and that's when you're having the multiple offers and overbids. And I think now you can avoid some of that because of this interest rate slowdown that we have right now.
Exactly,
Well,
William. Exactly
that
right.
is always a pleasure to get informed by you. And when you bring your charts, we're dealing with nouns and numbers and not all of these brother-in-law type adjectives that cloud the conversation. So I really appreciate that. If somebody has a question for you, how do they best get hold of you, and what recommend?
Well, the lovely world of Google, just Google my name, but phone number, I don't know if we can put that up on the screen.
Okay.
831-521-9378. And also you'll find our information online, but absolutely encourage any questions and to help guide people through this market. It's, you and I have been in this market a long time. We've seen lots of cycles. Each cycle is unique in themselves. This is with a world of so much information out there, I think the information people are receiving is doing them a huge disservice and creating a paralysis when this is the time they should not be paralyzed. But just get in the game, be ready. If nothing comes up, okay. But if something does come up and you're ready, you'll be able to to pounce on it and win in this market. So just here to help. I know you are as well, to help people win in this market.
All right. Well, thank you very much. And we're going to wrap it up right now. This is William Smith with the Carmel Luxury Group at Coldwell Banker Realty in Carmel, California. We've had the pleasure of speaking with Chad Hawker. He is the manager and lead lender at Synergy One Lending in the Carmel branch of Synergy One Lending. Thank you very much. I look forward to our next month's conversation. Thank you for keeping us informed.
Thank you, William.